Hello, welcome to Principles of Accounting 2010 Chapter 8 videos. In video 2, we are going to be looking at the balance sheet approach to estimating our uncollectible accounts. And we call it the balance sheet approach because we're going to be analyzing the account receivable. Now, from the previous video, when we did the percentage of sales, remember we would take a percentage of the sales, the credit sales for the year, and we would multiply that percentage to get our estimated bad debt or uncollectible accounts for the year. And we did not care if there was a balance in the allowance account. We would just simply apply that percentage to our sales totals, our credit sales totals, and we would add that to the allowance account. If we were off by too much, too little, or too much, in the next years we would adjust the percentage to more accurately reflect that percentage of sales that we would not collect, but we would not care what was the balance in the allowance account. However, under the percentage of receivables and the aging of receivables, we will be caring if the allowance account had a previous balance. So again, how we are going to do the calculations is under the percentage of receivables, we are going to have a historical percentage, just like we did in sales, that we believe we will never collect. And we will be applying that percentage to the ending balance of our receivables account. What do I mean by this? Well, at the beginning of the year we have some receivables from the previous year that we're carrying over, but we will have credit sales we'll be adding in. We will be writing off some uncollectible accounts. We will be writing down those accounts which we did collect, and that ending balance at the end is the amount that we will apply the percentage to. So we will have to make some adjustments to the account from whatever balance was given to us. I will be demonstrating this in a moment. So the steps under the percentage of receivables, you are going to have that historical percentage. You're going to multiply that historical percentage to your ending receivable balance, and then you are going to be looking into the remaining amount in the allowance account, and you will be taking this amount into consideration when you calculate your bad debt expense for the year. Any of those adjustments that I'll be demonstrating in the next problem, but for simplicity I'm going to give you the ending balance $100,000, and we anticipate, using our historical knowledge, that 3% of these will never be collected, or $3,000. Now, in the percentage of sales, we did not look to the allowance account. We simply would have adjusted for $3,000. But under the percentage of receivables, we're going to be looking at that and saying, oh, we've got $500 in the allowance account. What is going to be our bad debt expense? So under the percentage of sales, we would have just made this journal entry, bad debt expense $3,000, allowance for bad debt $3,000, and we wouldn't have cared. But under the percentage of receivables, we're going to look at that allowance account, and $3,000 is going to be a target we are trying to hit. So what does that look like? Well, we had the $100,000 ending balance in accounts receivable. We had a $500 credit balance in the allowance for bad debt, because remember, the allowance is the contra account to accounts receivable. Accounts receivable have a normal balance in the debit side. The contrary account would have a normal balance in the opposite, the credit side. We estimate that $3,000 will never be collectible. How much is it going to take to hit a target of $3,000? It's going to take us $2,500 to make that balance of $3,000. And that $2,500 is going to be our bad debt expense for the year. So let's go ahead and jump out to an actual problem that I've set up in Excel and work through it to demonstrate this more in depth. So in my problem, we had at the end of 2014 or at the beginning of 2015 a beginning balance of $2,000 in the allowance account. That is amounts that we had set aside, values we had set aside that we believe will never be collectible from any remaining accounts receivable. We had a balance in the accounts receivable of $10,800 at the end of 2014, so we carry it over to it as our beginning balance of 2015. Then throughout the year of 2015, I'll go ahead and say this is what's happened over 2015. In 2014, we had credit sales of $400,000. So in order to record a credit sale, we would put the $400,000. We know that the credit would go to the sale, and we'd have the debit go to the accounts receivable, a credit sale. So the journal entry would have been accounts receivable for the $400,000, which I've posted in the ledger, and we would have the credit go to sales of $400,000. So there you have your journal entry, there you have your postings in the ledger. The second step said that over the course of the year, we collected out of the total amount of accounts receivable owed to us $300,000. Well, I can go ahead and do the journal entry first this time. So if we collected $300,000, it came to us in the form of cash, $300,000. And if we reduced our accounts receivable, we will credit them for $300,000. And if we post those, we're going to have the credit to the accounts receivable and the debit will go to the cash. All right, so we've got a lot of things going on during 2015. Also during 2015, we wrote off $5,000. We determined that $5,000 of previously owed accounts receivable could not be collected. So we're going to go ahead and put the $5,000 in the allowance, take it out of the allowance account, because remember we had established and matched this $5,000 to previous sales. And we're going to take it out of our accounts receivable because we now realize we can never collect on it. So the journal entry, the corresponding journal entry, would have been the debit to the allowance account for the $5,000 and the credit to the accounts receivable, specifically whomever that pertained to. Kyle, in our previous example, whoever we determined did not pay, we would go ahead and take it out of their accounts. I'll go ahead and write Kyle. And it came out of the general allowance from when we did not know who we could not collect from. All right, so we have gone ahead and we have posted all these journal entries into the ledger. And now we are going to determine, based on our historical knowledge, how much do we believe will never be collected? Well, let's say that according to historical knowledge, we say that 3% of our ending balance of our accounts receivable, will never be collected. So we have to figure out what is our ending balance. Well, if we go ahead and we add up the debit side of accounts receivable, because that's normally where we find it, we subtract out any collections or write-offs, we see that we still are owed $105,800 in accounts receivable at the end of 2015. And we're going to go ahead and see what do we have as a balance in our allowance account. And we can see that we had started with $2,000 allowed for the write-offs, but we had actually needed to write off $5,000. So we have at this point what for a balance? Well, we've got $3,000 as a balance on the debit side. Well, that's not right. We should normally have a balance on the credit side in the allowance account. So we're going to have to make up that difference that we had taken out over what we had estimated would be used when we make our bad debt expense for this year. So step 2, we've calculated both the balance in the accounts receivable at the end of 2015, the balance in the allowance account. We look and we say 3% of the ending accounts receivable will not be collectible. Okay, so let's take 3% times the ending balance in accounts receivable. And we say $3,174 of that will not be collectible. Let's go ahead and put that. That should be what is our normal balance on the allowance side. So how much, what is going to be the target? What is the targeted amount? I'm going to go, how much does it take for me to have a balance, a credit balance in the allowance account of $3,174? Well, we're going to have to make sure we credit $3,174, and we're also going to have to add in that negative balance of $3,000. So if we add those two together, we can see that in order to have enough in our allowance account to start 2016, we are going to have a bad debt expense write off $6,174 to match the amount of estimated accounts receivable and to make up the difference of what we had underestimated for the previous year of $6,174. So that journal entry, to make that right, is going to be bad debt expense of $6,174, and the allowance account, allowance for bad debt, of $6,174. And so let's go ahead and take a look at how does that affect our financial statements. So at the end of 2015, we would have on the balance sheet $105,800 owed to us from those folks that we had allowed to charge on account. We will have in our allowance account $3,174, which we deem of that will not be collectible, for a net realizable value of $102,626. So the ending balance of accounts receivable of 2015 minus that 3% of the allowance for uncollectible accounts will give us a net realizable value of $102,626. Our income statement will then reflect that we had $400,000 in sales, and of those sales, the bad debt expense associated with those and previous sales, because we had not estimated correctly, of $6,174, which will give us net income, if that was our only expense, of $393,826, the amount of sales, credit sales, that we actually think that we will collect. In video 3, we will just be applying just a little bit more detail when we look at the aging of accounts receivable. The processes are very similar, but we are just going to more closely analyze the accounts receivable down to the individual person versus taking a generic percentage and applying that percentage.